through the question. Let's go through the question. The group structure. What's the group structure? We are starting from the group structure. So before you do any presentation, after you have done written this and this, the next thing is to do what? Do your group work. Group structure. Note 1. So the question says IIR Limited acquired IIR acquired the lower. How many percent equity shares? 60%. So ordinary share capital 60%. NCI will be what? 40%. Date of acquisition. Date of acquisition. DOA stand for what? Date of acquisition. So first of what? April 20 what?
17.
Then date of consolidation. 30th September 20 what? Then move to what? Duration. What's the duration? 6 months. 6 months. So because it is 6 months, because the duration is 6 months, that is, the acquisition was done on 1st of what? April. We are consolidating same year, right?
Yes.
We have IIR acquired the lower on 1st of April 2017. So consolidation date is also same year. So now when you count from April to September, so how many months we have? 6 months now. So what it means is that if you are giving the income statement of the subsidiary, and the SFP, now what you will do is that the SFP will be consolidated in full, but for the income statement of the lower, you need to prorate it by how many months? 6 months. So we are going to account for 6 months of that income statement of what do you call it? Lower. That's what you do. Don't consolidate in full. But remember, we are giving the income statement of lower 12 months income statement. Is that not? 12 months. So what you will now do is what? You have to consolidate what do you call it? Prorate lower income statement. So let's start. So we have revenue. So what's the revenue of IIR? 2,720,000. Plus what? How many months? If you count from April, May, June, July, August, September. That's how many months? 6 months. So we have 6 over 12 times. What's the figure for the revenue for 1,344,000. So that's that. This is your presentation. Now we said that what we are going to deduct from this revenue is what? Intercompany sales. So we'll get to that area. So let's leave this line. You move to the next line, and the next line is cost of sales. You can leave the line and move to maybe the third line. So cost of what? Cost of sales. Open the bracket. What's the sales for? Cost of sales for IIR. 2,016,000 plus 6 over 12 of cost of sales of 1024. So we leave enough space here. Leave enough space for cost of sales. Maybe you move to the next, leave a line, and you jump to the next line. So we have to go forward. Because we still need to add something there, deduct some things there. So we move to what? Gross profits. So our gross profit is going to be, when we do the adjustment, we have the gross profit here. So what's the next line? Distribution cost. So what's the figure? The figure for that? 64,000 for parents. For subsidiary? 64,000. For subsidiary, 64. So 6 over 12 times what? 64,000. Right? Do you understand now?
Yes, sir.
So what's the next thing? Admin. administrative, admin expense. Open a bracket. The parent company admin expense. 192. The parent 6 months of the subsidiary. 102,400. So we leave it open. Next.
Finance costs.
Finance costs. Finance costs. Open a bracket. What do you have?
9,600.
Ask a question. 9 what?
9,600.
9,600.
Yes, sir.
Then plus 6 months.
12,800.
12,800. So what do we have? We have a profit before tax. So we have not gotten the figure yet. So we need to still leave it. Then the answer is going to be profits. So these are expenses now. Abi?
Yes.
So once we deduct the expenses from gross profit, we are going to have what? Profits before what? Before tax. Or we don't know. We don't know now. Abi? We don't know yet. So next. Income tax. Are we giving income tax?
Yes.
Open a bracket. Parent company income tax.
150, 400.
150
400.
plus what? 6 months of
44,800.
6 over 12 times 44,800. So we don't know the adjustment. We have not done that, so we'll come back to that. So whatever answer we have here, we are deducting it from this profit before tax. So to arrive at profit for the year. Profit for the year. This is the presentation. Profit for the year. So this is how you present the solution before you even treat the additional information or whatever. So that's for what do you call it? The consolidated statement of profit or loss. Any question? Any question on this?
So for Olu,
No, we are not in. Okay, 1, 2, 4, yeah.
And it's 9 months. I'm supposed to give the same one.
Yes, if it's 9 months, it's going to be 9 over 12 times this. If it is 9 months, that's why I said you need to check the duration, the date of acquisition, from date of acquisition to date of consolidation. You use that to count it to. Now suppose this is 30th April, so it's going to be what? 5 months. It's going to be 5 months because you are not going to consider April, so it's going to be May, June, July, August, September, fine. But because it is now first, you have to consider 1st of April, May, June, July, August, September, 6 months. So any question? Any question? So let's. That's why I said the first thing you do is group structure. When you do this one, then this will tell you how you are going to consolidate. Do you understand now? Whether you are consolidating in full or you are going to operate the income statement of the what do you call it, subsidiary. But when you are doing what do you call it, the SLP, the group consolidated statement of financial position of the two companies, don't prorate the subsidiary asset and liability. Don't prorate, please. You only prorate the income statement. Yeah, only the income and expenses that you prorate. Any question?
Sir, is it possible that they tell us to solve only the lower limited P&L?
No. Consolidation now. Yeah, consolidation. Yeah, consolidation is about what? Combination. Combination of assets, income, expenses, liability. The only thing you don't consolidate is what do you call it? Equity component of the sub. You don't add the sub equity component to the parent yet. So that's that on this. Now the presentation of what do you call it? This SFP. So let's do this one. We have assets, assets. What do we have here? Non-current assets. Provide this PPE,
Yes.
property, plants, and equipment. So open a bracket. We are consolidating in food. The figure for parent figure.
1,299,200.
1,299,200. We are consolidating in food. So what's the figure for parent subsidiary? 403,200.
Yeah.
Okay. So you leave it open. We need to adjust this too, right? We move to the next line. What's the next line? Current asset. Any cost of investment in the subsidiary? Any information about that? So no information about cost of investment in the sub. Okay, so there's something missing there. What is missing when we consolidate? Goodwill. Okay, let's have that goodwill. We are going to, determine this. So we move to the next one. The next line item is what? Current assets. Current assets. Any breakdown of current assets? No breakdown. So we have a long figure. So we open a bracket. What do we have? So what it means is that this current asset consists of inventory, receivables, cash, bank. Abi? There is a short-term investment. You can have it here. So what's the figure here?
512,000.
512,000. 512,000. 211,200. Please always leave a non-space here for the total figure. You get? So we are done with that. So I will leave a line here. In your book, just leave a line where you include the total assets. This is total assets. Total assets. Total assets. This is total assets. So we move to the next. We are done with the first section. So we move to equity and what? Equity and liabilities. Equity and liabilities. So we start with what? What do we start with? Equity.
Equity shares of money, right?
Do we have share capital or equity share?
Equity
Is it share? Equity share? Yes. Okay. Equity share. We are not consolidating this area. Equity component of parent and subsidiary will not be consolidated. We only show the equity component of what? The parent. So what do we have? So I told you about this equity component that we have two that is classified into two. We have the existing and the existing shares, the share capital and what? The new. So where can we get the existing share capital? The existing share capital. Existing is from the SFP now. Existing is the one in the SFP. So what's the existing in the SFP? Existing share capital. 320. Can post that one. 320 post. So for new share capital, the new share capital will arise where there is share exchange. Yes, exchange of shares. You remember that we said we have 5 consideration. The first one is what? Cash consideration, deferred consideration, share exchange. What else? Contingent consideration. Then we now have what? Loan. So these are so you always create a space or a room for the new in case there is a share exchange. So you open create a space for that. Then we now move to what? In the question, what form of purchase consideration are we? We have share exchange. Which other form? Do we have other form of purchase consideration? Do we have cash? But there is no cash. There is no cash. So we have share exchange. Which other one? You have deferred. No deferred. No deferred. Just share exchange. Okay. So let's go to share premium. Any share premium? No.
Yes, there will be share premium.
There will be share premium whenever you have what forward. There will be share premium whenever you are giving the share exchange. There will be share premium. So let's create a space for share premium. Share premium. Share premium. So since we do not have any share premium in the SFP of the parent from the IIR, so we can say that this one is going to be the new share premium, not the existing one. So we look to the next one. So we need to determine this. So what's the next one? Retained earnings. Retained earnings. Retained earnings. We need to determine this. We need to determine this. Then next one is what? NCI. We determine this too. Right? So any other one. This is what we call, this area is what we call what? The equity component. What's the next one? The next non-current liability. So we move to non-space, maybe 2 lines. Non-current liability. Non-figure. Any information? Is there any breakdown? 10% loan notes amount. Are we consolidating this area?
Yes.
Equity, liability?
Yes.
Yes. So loan notes. Open the bracket. Parent?
96,000.
96. Subsidiary?
128,000.
120.
128.
Okay, 128. So we are consolidating this. Do we have information about any additional information on loan notes? Any additional information on loan notes? So if there is no additional information on loan notes, what do you do? What do you do? You add it together, you post, add it to. Since there is no information, no additional information on that, bonus mark, add it together and post. What's the figure?
224,000.
224,000. Like this. Any other line item? Any other line item?
Current liabilities.
Ask question. Any question? Ask question. Okay. Current what?
Liabilities.
Any breakdown?
No.
Okay. Current liability. So open a bracket. What do we have?
260 to 400.
Current liability. Liabilities are big.
Yes, sir.
So what do we have?
260 to 400.
262.
260 to 400.
262.
400.
Then plus that of subsidiary lower.
150, 400.
150, 400. Don't sum the two figures, just leave it. Because we still need to, there is an additional information on that. Abi? So now we are done with this presentation. This is what we call presentation. You present like this in exam. Do you understand? Then after doing this, you can now go back to the notes. Come back to these notes, go to the account. So you can start. So you can decide anyone you want to, any line item you want to, sum up. You can sum it up. So this is note 1. Now let's go back to the additional information. Let's go back to the additional information. How many additional information do you give?
5.
We are giving 5 additional information. So what's the first one? Let's read the first additional information. The first one. No, who is reading from the beginning? From the beginning. No, let's just read the first the statement. Do we have any first statement? First one at the beginning. We have told that on 1st of April 2017, ICAN acquire 60%, which is this 60%. Okay.
Equity share capital of lower.
Yes, equity share capital. Yeah. This person.
Okay. In a share exchange of 2 shares in higher.
In a share exchange. In a share exchange of 2 shares
in higher for
So-
3.
So the purchase consideration is purchase consideration. Let's create space for purchase consideration. Purchase consideration. So the purchase consideration used there is what? Share exchange. I mean,
Yes.
share exchange. And they said,
2 shares.
how do we exchange? How do we determine the exchange? The shares between. They said 2 for 3. Abi?
Yes.
2 for 3. That is 2 over 3. 2 for 3. That is 2 over 3 of the acquired. 2 over 3 of the acquired shares. Now, 2 over 3 of the acquired. That is times acquired. Acquired what? Acquired shares. Who is acquiring shares? IIA is acquiring how many percent shares? 60% share capital. Abi? So he has this person, this one, company IIA has 60% equity share capital of what? Lower. So what we do here, what we are going to do here is that what is the entire share capital? What's the entire shares in lower? How do we know the number of shares taken by IIA? So let's look at what? Total shares in total shares in lower. So what's the total shares? Go to the equity component of lower. What do we have there? 128,000 naira. Abi? 128,000. Abi?
Yes.
128,000. Like this.
Yes.
Yes, sir.
Like this, Abi?
Yes, sir.
So let's let's consider this 302. Let's consider it in full. This 128 million naira. Abi? Now, what is the nominal shares?
1
1
naira.
naira. So you now divide it by what? 1 naira. To know the entire shares. So what's the entire shares here? 128. Abi? 128 million shares. Shares. Abi? 128 million shares. Is that not? So now the entire shares in lower is what? 128 million shares. That's the entire shares. 128 million. So if this person is now taking 60% of 128, so how many shares is higher taking? How many shares is he taking? So it's going to be what? 60 over what? 100 times what? 128 million shares. 128 million shares. So how many shares is he taking? 7 what? 76 million shares. Is it 76? 800,000 shares. Now the remaining shares now will be allotted to NCI. So parent company is taking 76 million 800 what? 800,000 shares. Out of 128, the remaining shares will be allotted to NCI. So what's the remaining one allotted to NCI? So minus this from this, we have what? 51,200,000 shares will be allotted to NCI, the non-controlling interest. Is that not? Is that not? So at this junction or at this point, if I want to know the value of NCI, where you are told that NCI is measured at fair value and the market price of the subsidiary share is 3 naira or 1 naira or 4 naira or 5 naira. All you need to do is what? Multiply that price, market price by what? The number of shares allotted to what? NCI. You get the value of the fair value of NCI. Do you get?
Yes.
You get to that point. We are looking at the value of NCI, where NCI is measured at fair value. NCI can be measured at fair value or at what? Proportionate. You get. So when it is measured at fair value and you are not giving the value, so all you need to do is to look at the entire shares. Then when you look at the entire shares in lower, this is the entire shares in lower. How did we get this? We divided the nominal share by the share capital to get the shares. Now this is the total shares in lower. Now how do we know? Because there are two owners here. The first owner is what? III. The second owner is what? NCI. So I want to know the number of shares attributable to parents. III is the parent. So the number of shares attributable to parents is 60% of 128 million shares, which gives 76,800,000 shares. So this belongs to the parent III. So the remaining shares, which is 51,200,000 shares, belongs to NCI. So I said if NCI is now measured at what? At FV, fair value, and the market price of the lower is given to be, let's say market price is now, market price is let's say 3 naira. If the market price is 3 naira, all you need to do is what? Multiply 3 naira by what? By the number of shares allotted to NCI. You get the value to be in naira, not shares. Noted, right? So any question on that? Any question on that?
So that when sharing the shares, like the way you share it here now, and for every 2 shares, 2 over 3, will you also do that for the NCI? No.
You said, no, we don't do that.
You share the shares, 2 over 3 and the acquired shares.
Yes.
And the amount and the market shares, the price of the shares. Will you, so when you analyze the value for the NCI, will you only 40% of the shares acquired by the NCI?
Noted now. So now so let me ask you a question now. The acquired shares is what? The acquired shares by IIR is what here? What's the value of acquired shares now? The shares acquired by IIR. What's the shares acquired by IIR? This is shares acquired by IIR. 76 million.
800,000.
Yes. So now when you go back to this share exchange, it means that I have taken shares from lower. I want to give you my own shares. That is share what? Exchange. So IIR has taken 76 million 800 shares. So IIR now want to give who? Lower, the shareholders of lower, its own shares. So how do we give the shares? How do we allot the shares? Now say that two